One day, Dave walks into a store and sees a stick. Shiny. Triple camera. Don't ask me why a stick has 3 cameras. It costs $1,000. Dave doesn't have $1,000, but he has a credit card. He pays, grabs the stick, and leaves. Wait, there's more. With that purchase, Dave also just earned 2,000 points. The merchant checks the bank account. $990. So Dave paid with money he doesn't have. He even earned points. And the merchant got less money. What the heck is going on? What is a credit card, really? It's a tool that lets you move money from the bank to the merchant. The word credit may sound fancy, but translated, it's debt in a fancy outfit. When you use a credit card, the bank pays for you. Then they send you the bill, and banks are really good at collecting debts. Usually you have about 30 days to pay it all back. If you pay in full, no problem. But Dave sees 2 amounts on his credit card statement. Total owed, $1,000. Minimum payment, $25. Dave thinks, perfect. I'll pay $25 and I'm good. Sure, Dave, welcome to the dark side of Minneapolis. If you only pay the minimum, the rest stays there. And on top of that, they add interest. In the US, the average credit card interest rate is over 20% per year. And here comes the Demogorgon, compound interest. Compound interest is something Dave never understood because it's not interesting. I really need some friends. Let's look at a concrete example. Suppose after the minimum payment, $1,000 remains on Dave's account with an annual interest of 20%. After 1 year, the debt becomes $1,200. But here's the point. The next year, the interest isn't calculated on the initial $1,000. It's calculated on the $1,200, which becomes $1,440. And the year after, the interest is calculated on $1,440. And so on. The bigger the debt, the faster the interest grows. And when you pay only the minimum, a large part of your money goes to cover the interest, not reduce the initial debt. But I always pay in full. Perfect. Good job, Dave. So the credit card is free? Not quite. Many credit cards have fees. Want to have it? Fees, pay late. Fees, want to withdraw cash. Fees, want to pay abroad. Fees, and of course, the processing fees. Remember those $10 that disappeared during the stick purchase? They mostly went to the bank that issued the card, and a smaller part to the bank handling the POS and the companies managing the payment networks. Okay, but they still reward me with points, and with points I get lots of free stuff. In Minneapolis, credit cards are huge for one main reason: rewards. Okay, Dave, let's do some math. You spend $1,000, you get 2,000 points. Sounds nice. But rewards are not a gift, they're an incentive. To get a free flight, you often need 20,000, 50,000, or 70,000 points. Translated, you have to spend tens of thousands of dollars. Banks don't give away flights because they love you. But the credit score is important. Absolutely. In Minneapolis, that number decides how trustworthy you are. Above 740 is good. Above 800 is excellent. Below 580, let's just say getting loans becomes tricky. The paradox? To build credit, you have to use credit. And so the credit card becomes almost mandatory to enter the system. Credit cards are powerful tools, but with great power comes great responsibility. They can protect you from fraud better than a debit card, help you in emergencies, build a credit history, give you small perks if used responsibly. The problem isn't the credit card, it's the illusion that it's free money. To understand how much banks make from this, try calling them saying you lost it and watch how quickly they block it and give you a new one. The system works because many people pay only the minimum, accumulating interest. In banking lingo, they're called revolvers. Also, the majority spend more easily with a credit card. In banking lingo, they're called Daves. In 2025, in the US, credit card debt exceeded $1 trillion. It's not an accident. It's not people being careless. It's a business model. How Dave uses it once he learned the lesson. Dave learned a few things. The credit card is not an extension of his paycheck. He only spends what he can pay in full at the end of the month. He keeps utilization under 30% of the limit. He sets an automatic full balance payment. He doesn't chase rewards that push him to spend more. And above all, he doesn't get seduced by every ultra-platinum black elite you're special and part of a billionaire club. Hope you enjoyed the video. See you next time.